Say you walk into an open house this Sunday. Fresh paint, staged couch, cookie smell they pipe in from somewhere. The agent hands you a flyer and says the sentence every American gets read at birth: renting is throwing your money away. Here's the problem. In 2026, the spreadsheet says she's wrong. The spreadsheet says the house is the money pit and the renter is the genius. And yet the typical homeowner in this country is worth about 40 times more than the typical renter. 40 times. Both of those things are true at the same time, and by the end of this you'll know which side of that line you belong on. Start with what a house costs now. The median existing home in America sold for $429,300 in May 2026. The average 30-year mortgage rate as of the first week of July is 6.43%. In January 2021 it was 2.65. Take the same loan, call it $343,000 after 20% down, about $1,400 a month at the 2021 rate. About $2,150 at today's. Same house, same debt, roughly $770 extra a month for showing up 5 years late. Oh, and that 20% down. Almost $86,000 in cash before anyone hands you a key. Now stack that against paychecks. To afford the median home at today's rates, a household needs to earn about $107,000 a year. The actual median household earns about $84,000, which means the average family buying the average house would be putting roughly 40% of its income into housing. The old rule says stop at 30. People got the memo. The National Association of Realtors says the typical first-time buyer is now 40 years old. 40. Back in 1992, it was 28. And first-timers have shrunk to about a fifth of the market, the smallest share the realtors have ever recorded. Walk across the street and look at renting for a second. The typical asking rent in America is about $1,895 a month right now, and it's barely moving. Rent growth is the slowest it's been since 2020 because a construction boom just dumped a flood of new apartments onto the market and landlords suddenly have to compete for you. This past January, about 4 in 10 rental listings on Zillow came with a concession. A free month, a waive deposit. In Austin, San Antonio, Tampa, and Denver, rent is actually cheaper than it was a year ago. Put the two side by side. Census data says the median homeowner with a mortgage pays about $2,035 a month, while the median renter pays about $1,487. LendingTree ran that comparison across the 50 biggest metro areas in the country, and renting won all 50. Every single one. And that's before the house starts eating. Bankrate added up everything owners pay beyond the mortgage. Maintenance, property taxes, insurance, utilities, the boring stuff. It averages $21,400 a year. Almost $1,800 a month before a single dollar of principal. The boring stuff is also getting worse fast. Home insurance jumped 12% in 2025 and it's still climbing. Property taxes are up about 27% nationally since 2019, and in states like Colorado and Georgia, they are up more than 50%. When the water heater dies at 2 in the morning, a renter sends a text. An owner gets a quote. But the flyer says the house is an investment. Is it though? Robert Shiller won a Nobel Prize partly for building a home price index that goes back to 1890, and here's the ugly result. After inflation, American houses have gone up about 0.7% a year, under 1% for 130 years. And right now it's worse than that. As of April 2026, national home prices were up 0.8% from a year earlier. Inflation ran hotter than that, so the average American house lost about 2.4% of its real value over the past year while its owner mowed the lawn. The S&P 500, for comparison, has averaged about 10% a year since 1926. Roughly 7 after inflation. It returned 26% in 2023, 25 in 2024, 18 last year, and it's up around 9.5 just since January. Give both assets 30 years at their long-run pace. $100,000 in the index becomes roughly $760,000 in today's money. The same $100,000 riding house appreciation becomes about $123,000. As a pure investment, it's a blowout. Selling is where they get you again. There was a giant lawsuit about agent commissions that settled in 2024, and everyone predicted fees would crater. They didn't. The average total commission in 2026 is about 5.7%, basically where it's been for years, and once you add the other closing costs, unloading a house can eat close to a tenth of its price in some states. That's why every honest calculator says the same thing: if there's a decent chance you move within 5 to 7 years, buying loses. Full stop. Which brings us to the part where the house becomes a prison. More than half of American homeowners with a mortgage are sitting on a rate below 4%. The average across all existing mortgages is about 4. Today's rate is 6.4. So the promotion in another city, the bigger place for the second kid, the divorce, the fresh start, whatever it is, now costs hundreds of extra dollars a month in interest every month for decades. Federal researchers estimate this lock-in effect erased about 7 million home sales between 2022 and 2024. Families who wanted to move ran the numbers and sat back down. The cheap mortgage everybody envies turned out to be a set of golden handcuffs. So the renter's playbook basically writes itself. Rent the place for $1,895. Keep the $86,000 in your pocket, let the water heater be somebody else's problem, stay free to chase any job in any city on 60 days notice. Take the monthly difference, somewhere around $850 once you count everything, and drop it into a boring index fund every single month. At the market's long-run real return, 30 years of that lands close to $1 million in today's money. Renting is the smart move. The math is done. Case closed. Except, the Federal Reserve runs the definitive survey of American household wealth, and the latest numbers are these. Median net worth of a homeowner, $396,200. Median net worth of a renter, $10,400. The renters were supposed to be the ones quietly getting rich on index funds. So where's the million? Some of the gap is selection, to be fair. People tend to buy houses once they are already doing well, and renters skew younger and lower income. But the gap is 40-1, and it's been widening since the 80s. Something else is going on. That something is the phrase doing all the heavy lifting in the renter's playbook: invest the difference. Because almost nobody invests the difference. The Fed's own survey of household well-being came out this May. 37% of American adults said they couldn't cover a $400 surprise expense with cash. Only about half have 3 months of expenses saved. For most households, the difference just gets absorbed. A subscription here, a trip there, a slightly nicer car, and the $850 is gone with nothing to show for it every month for 30 years. And the people who do invest. A research firm called Dalbar has tracked this for decades. In 2024, the S&P returned about 25%, but the average equity fund investor captured 8.5 points less than the index they were sitting in because they kept hopping in and out at exactly the wrong times. Over the last 20 years, the index did 9.7% a year. The average investor inside it earned 8.7. One little point, and on $1 million over 20 years, that 1 point compounds to roughly $1 million of missing money. Spring of 2025 was a live demonstration. Tariff panic knocked the market down almost 19%. Anyone who bailed locked in the loss, then watched the market rip 39% off the April bottom and finish the year up 18%. The index was never the problem. The hand hovering over the sell button is the problem. Now look at the boring old mortgage again through that lens. You can't panic sell a kitchen at midnight. You can't skim $20 off your living room for takeout. The payment drafts itself every month, rain or shine, and a slice of it is principal, which is just money moving from your checking account into a vault you happen to live in. Economists call it forced savings. For a huge chunk of Americans, it's the only savings plan they will ever actually complete. It even comes with leverage. Put 10% down, and a 3% bump in the house price is a 30% return on your cash. Careful, that math runs in reverse too. Ask anyone who bought in 2007. But add it all up, and this is how a mediocre asset built the American middle class. Homeowners are sitting on roughly $35 trillion of equity today. And a house pays one dividend the stock comparison always leaves out: you live in it. Every month you don't hand rent to a landlord is a quiet return, even in years when the price goes nowhere. So here's the honest scorecard, the one neither the flyer nor the finance bros will give you. Rent if you're mobile or disciplined, ideally both. If there's a real chance you move within 5 to 7 years, transaction costs decide the whole thing. Rent and don't look back. And if you're the person who kept buying index funds straight through the April 2025 crash without blinking, congratulations, you're the spreadsheet person. For you, renting plus investing is probably the wealth maximizing play, and the data backs you. Buy if you're honest enough to admit you'd spend the difference. If your track record puts you anywhere near that 37%, the house is your commitment device. A trap, yes, but a trap you set for your own worst instincts, and one that hands you a fixed principal and interest payment while rents do whatever they'll do over the next 30 years. Taxes and insurance will still creep, ask Florida. But the biggest line of your housing bill freezes on day one. Buy if you're staying put 7+ years. Buy if painting a wall without permission genuinely matters to you, because that's a return too, it just never shows up in a brokerage statement. Either way, walk away from any deal that swallows 40% of your paycheck. At that point, it stops being a home and starts being a hostage situation, no matter what the flyer promises. So is owning a home a scam? For a mobile, disciplined renter who actually invests the gap, buying today would honestly be a downgrade. For the other guy, the one with 3 subscriptions he forgot to cancel, that overpriced house might quietly become the only $400,000 he ever saves. A house is a mediocre investment stapled to a savings plan that works. An index fund is a great investment stapled to nothing. What wins is staying in for 30 years, and no spreadsheet can do that part for you. Which raises a stranger question. If forcing people to save is the one trick that reliably works, why does every other account in your financial life come with a big, friendly withdrawal button?